The entire AI investment thesis is built on one assumption, but that assumption may be wrong. Over $1 trillion in compute contracts, signed, committed, locked in. And the company at the center of it all may not be able to pay for them. Here's the reality. The AI infrastructure boom isn't just about chips and data centers. It's a financial architecture, a circular system of deals and obligations, one that only works if a single thing keeps happening: growth. What happens when the growth stalls? What happens to the companies that built their entire business model around a single customer's expansion? And what does this mean for every AI investment you're watching right now? That's what we're examining today. Hey, welcome to New Stock Signals. I'm Max, the digital twin of Bill Smith, founder of Renaissance Capital, which for over 30 years has analyzed more than 11,000 IPOs. Bill personally researches and writes every video script himself. I hope you enjoy. He reads every comment, so be sure to share your thoughts below. Nothing in this video constitutes personalized investment advice. Always consult your own financial advisor before making investment decisions. Let's get into it. This matters to you. Whether you own AI stocks, are watching IPOs in this space, or are simply trying to understand where this market is heading. The structure of how AI is being financed is more fragile than the headlines suggest. We're going to break down how this system actually works, where the pressure is building, and what serious investors should be watching right now. We've seen this pattern before. In the late 1990s, telecom companies built fiber networks on the assumption that internet demand would grow fast enough to justify the cost. It was a rational bet. It was also wrong, at least in the near term. Companies borrowed against future demand that didn't arrive on schedule. When growth slowed, contracts got renegotiated. Debt became distress. The whole chain unraveled. That's not a prediction. That's history. And right now, there's a structural dynamic in AI that deserves the same level of scrutiny. Here's how the system works. A major tech company invests capital in an AI lab. In return, that AI lab commits to purchasing computing services, cloud infrastructure, chips, data center capacity from that same investor. Round and round it goes. It's elegant when it works. Everyone grows together. Everyone benefits. But the whole structure depends on one thing: the AI lab generating enough revenue to pay for those computing commitments. OpenAI has reportedly missed its internal revenue targets. Its CFO acknowledged that if revenue doesn't accelerate, the company could struggle to meet future computing obligations. Those obligations across Microsoft, Oracle, Amazon, and more now reportedly exceed $1 trillion. Now, OpenAI disputes the narrative. Leadership says the business is performing well. The mood inside the company, they say, is positive. That may be true. But here's what actually matters. Even the suggestion of a revenue shortfall exposes something the market hasn't fully priced in, that these deals aren't as ironclad as they appear. A senior Morgan Stanley analyst flagged this directly, pointing out that even legally non-cancelable contracts can get renegotiated when a major customer runs into financial trouble. The analogy he used: retail leases during the pandemic. Everyone assumed those leases were binding until they weren't. This isn't about whether OpenAI succeeds or fails. This is about understanding what happens downstream if the growth trajectory bends. Because it's not just OpenAI's problem. The ripple effect runs through the entire AI investment ecosystem. Think of it like this. NVIDIA pledged to invest up to $100 billion into OpenAI, tied to the deployment of its own hardware. If computing contracts get renegotiated, that's not just a revenue miss. That's a demand signal for chips. Then there are the AI neo-cloud companies, Lambda Labs, CoreWeave, and others, many built specifically to serve the infrastructure demand that OpenAI and similar labs were expected to generate. These companies are now in an uncomfortable position. They built capacity based on a demand forecast that may shift. So what should serious investors actually do with this? Three things. One, separate the infrastructure bet from the application bet. Companies that sell picks and shovels to AI labs carry a different risk profile than companies building AI-powered products with real paying customers. Know which one you own. Two, watch the revenue quality, not just the revenue growth. The question isn't whether an AI company is growing. The question is whether that growth comes from diversified, paying customers or from a concentrated set of circular commitments within the ecosystem. Three, recognize that renegotiation risk is real. Don't assume that signed contracts equal guaranteed revenue. Build that uncertainty into your analysis. History may not repeat, but it often rhymes. The investors who protect capital in this environment aren't the ones who saw AI coming first. They're the ones who understood the financial plumbing underneath it. Now, I want to be fair here. OpenAI is not in crisis. They continue to pursue massive partnerships. As recently as February, they expanded their Amazon commitment by $100 billion. That's not the behavior of a company in retreat. And here's the other side of the argument. The AI infrastructure build-out may simply be running ahead of monetization, not failing. Many of the greatest tech platforms in history went through periods where infrastructure investment outpaced near-term revenue. Amazon Web Services, Netflix, Google's data centers. The model eventually worked. The question is timing and durability. My point here is the circular nature of these deals creates concentration risk that isn't visible in a headline or a stock price. Discipline means seeing that and pricing it properly. Here's the bottom line. The AI infrastructure story is compelling. The opportunity is real. But the financial architecture underneath it, the circular commitments, the contracted obligations, the assumption of perpetual growth, that deserves scrutiny. The investors who win in this cycle won't be the ones who are most excited about AI. They'll be the ones who ask better questions. If this is the kind of analysis you want more of, subscribe. We cover IPOs, new stocks, and the AI market reset every week. The kind of institutional-grade insight that used to be reserved for the big players, now it's available to every serious investor. Hit like, subscribe, and drop a comment. I want to know, what's your biggest question about the OpenAI deal structure? The biggest risk in AI investing right now isn't missing the opportunity. It's misreading the structure beneath it.